Hello and welcome. Thank you for being part of Equivault Company. Today we are starting our journey together with session number 3. In today's session, we will cover 5 important topics. First, what is a pip and why it matters in trading. Second, the different lot sizes, standard, mini, and micro. Third, we will calculate how much a pip is worth in USD. Fourth, we will explore the types of traders according to time frame, like scalpers, day traders, swing traders, and position traders. Fifth, we will introduce the basics of risk management to protect your capital. Let's talk about a very important concept in trading, the pip. A pip stands for point in percentage. It's basically the smallest price movement in the Forex market. Think of it as the unit we use to measure how much the price goes up or down. Most currency pairs are quoted with 5 decimal places, and the pip is usually the 4th one. For example, if the price of IUSD moves from 1.11500 to 1.11510, that's a movement of 1 pip. But there are some exceptions. For pairs with the Japanese yen, prices are quoted with 2 decimals. Gold and indices usually go only 2 decimals. Here's a simple example of how we calculate pips. Imagine you buy GBP/JPY at a price of 139.40 and later sell it at 139.90. The difference between these two prices is 50 pips, which could be profit or loss. Another example, this time with gold, or XAU/USD. Imagine you sell gold at a price of 3,630.00 and later buy it back at 3,629.75. The difference between these two prices is 25 pips, which could be profit or loss. That's how we calculate profit or loss in trading. The pips tell us exactly how far the market has moved. In Forex, trades are not measured in single dollars, but in something called lots. A lot represents the volume of your trade, or in other words, how much money you are putting into the market. So a bigger lot means you are trading more units of currency. So every pip movement will have a bigger impact on your profit or loss. When you trade in Forex, you are not buying or selling just $1. You are trading units of currency. There are 3 main types of lot sizes. A standard lot is 100,000 units of the base currency. Every pip movement is worth about $10. A mini lot is 10,000 units. That's 10 times smaller, so every pip is worth about $1. A micro lot is 1,000 units, much smaller, so every pip is worth only about 10 cents. That's why lot size is one of the most important tools for risk management. If you pick a size too big, your account can be at risk very fast. But if you choose the right size, you can trade safely and keep control of your money. Now let's talk about different types of traders. First, we have the scalpers. Scalpers are in and out of the market very fast. They only keep a trade open for a few seconds to a few minutes, trying to catch small moves. Next, the day traders. As the name says, they trade within the day. They can hold a position for minutes or a few hours, but they always close everything before the day ends. Then we have the swing traders. They are more patient. A swing trade can last for several days or even weeks. They look for bigger price moves and trends. Finally, the position traders, also called investors. They hold trades for a very long time, weeks, months, or even years. They focus on big trends and fundamental changes in the market. Now let's talk about risk management in trading. Risk management is all about protecting your capital so you can stay in the market for the long term. The first rule is never risk all your money in one trade. A good practice is to risk only 1 to 2% of your account per trade. Second, always use stop loss and take profit. These tools protect you from big losses and help you secure profits automatically. Third, focus on the risk-to-reward ratio. For example, risking $1 to try to make $2 or $3. Also, remember that leverage gives you more trading power, but it can also increase your losses, so use it carefully. And finally, Be consistent. Trading success is not about one big win. It's about steady growth over time. In simple words, risk management means protecting yourself first so you can trade again tomorrow. Thank you for your attention. Keep learning, keep practicing, and we will meet again in our next session.